Okay, we're live. Off you go, Charanjit. It's all you're muted, Charanjit.
Oh, hi. Okay, hi everyone. Thank you. Thanks, Surinder. Yeah, I'd like to welcome Akhil Mayor to Property Professionals this afternoon. Akhil is the Managing Director at our Mortgage Broker Limited. He's got extensive experience in the UK banking, corporate finance, and residential and commercial mortgages since 2002. He's a seasoned property investor who's bought and sold property pre and post the 2009 financial crash. Just a little bit about our mortgage brokerage. It was founded with the goal in mind of being the most trusted, preferred, and sought after residential and commercial broker in the UK. They're a specialist finance brokerage offering a wide range of financial services for a variety of purposes, including short-term finance, bespoke financial solutions for residential and commercial clients. And I'll hand over to Akhil. Welcome.
Thank you, Charanjit, for a warm welcome, and it's nice to be back on the TPP channel again.
Great to have you again.
Welcome.
Thanks, Bob. So what we're going to do today is just give a quick flavour of about how the market is at the moment and whether buy-to-let is dead or not. So what I wanted to do is just give my views on the current market, what's happened over the last 46 days and the last few days since that we've got a new Prime Minister in the top seat at number 10 in the name of Rishi Sunak. So it's good to see Rishi joining the new leader of the government, Conservative Party, I should say. So my views on buy-to-let are still very, very much optimistic, still a great asset class to invest into. And the simple reasons are, I'll read off a couple of reasons why I still think buy-to-let is a great asset class, a great investment channel where we should all use that as a return on our income, return on our investment. And some simple reasons are the shortage of homes being built, hence why house prices keep going up. So it's a legacy issue. Salaries versus house prices. Salaries are not where they should be compared to house prices. The average house price is nearly 300,000 now. However, average incomes are circa 25 to 27,000 in the UK. So there's quite a deficit in terms of loan to income ratio. There are potential tax advantages as well investing into UK properties. We're not tax advisors here at our mortgage broker, but what we do recommend is taking up holistic tax advice from reputable firms that understand your property goals, your income, and your property goals in the future as well. The other thing why I like buy-to-let property, and the other reason why, is it provides passive income by way of rental yields. Historically, where we are in London and the home counties and southeast of England, yields have been quite great. They've been very, very generous. And also the capital growth year on year has been quite buoyant. We've had double-digit growth over the last few years and in many decades previously as well. So that's great for that perspective. The number of buy-to-let lenders are also growing, and the demand for rental properties is growing, and we can see that by looking at average rental house prices going up and up. I would always say we must not confuse this recession to what took place in 2009. Lenders have got ample amount of cash. This is not a liquidity issue. This is not an over-leveraged issue. This is more on a global economic basis. We've got the war. Sorry, we've got the ending of coming out of Brexit. We've got the war between Russia and Ukraine. We've got the spike in energy prices. We've had turbulent time in our own home ground UK government. We've had a few chancellors. We've had a few prime ministers. Over the last 45 days or so, we've had a mini budget. I like to call it the explosive budget by Kwasi Kwarteng and his mini budget and what he said. And what that did is spooked the money markets, which in turn meant the UK borrowing became more and more expensive. As the UK government, the rating agency downgraded the UK as a sovereign country, which meant borrowing went up for the UK government, and in turn meant us as borrowers and homeowners and buy-to-let investors cost us more now to borrow for mortgages on term products. Now, what's happened over the last, as I said, 50 days or so is been turbulent. It's been a lot of uproar in terms of borrowing, and more importantly, for those that are on standard variable rates, it's meant for those ladies and gents that their mortgages have now just increased rapidly. We've been used to basically having Bank of England base rate very close to 0% for nearly a decade. Over the last 6-7 months, we've had an increase in the Bank of England base rate, and now it currently sits at 2.25, with subsequent rises coming into play with the next decision on November the 3rd. My small opinion is we're going to see a 0.75 increase. Rightly or wrongly, we've got inflation to battle with, and it needs to come down. The best way of battling inflation is simply increasing interest rates. However, it's not the be and end all of reducing inflation. You've got to look at cost of living, the supply and demand issues across the world. These are all factors that play into rise in inflation. However, I'm as optimistic as probably most of us in this room and viewers that are watching us on the social media channels, where we are optimistic and we are renowned property enthusiasts. We love real estate for the right reasons, but we're now entering a new phase, and we have this every 10, 12, 14 years, where what we did in our businesses previously doesn't work always going forward. Now, what that means is we need to get a bit more closer to the numbers. It means that we might need to get closer to specialists in the property arena. That could be the likes of tax advisors, accountants, the likes of Bob and myself as mortgage brokers as well, to understand more about mortgages, understand about your investment strategies. Do you need to consult with people like us that have got good and solid experience in the industry, where we can pass further comments on how to invest into property going forward? Because it's very true, what worked yesterday doesn't always work tomorrow and beyond. So it's key that using us as specialist mortgage brokers, that we understand how the market is changing, what pivots are happening in the market, and what trends that we foresee and that are coming up. And the good barometer of looking at trends is looking at auction houses and understanding what's coming onto auction and what's being sold, because that's a great barometer to understand where the market is moving in the next 3, 6, and 9 months. Just quickly touching on interest rates. Now, the effect of increase in base rate doesn't affect anybody on fixed rate mortgages. So if anybody has a fixed rate mortgage that is tied up for, say, for example, for the next 12 months, the next 24 months, and the alike, you don't need to worry, because your payments are fixed for that period of time until your mortgage comes up. However, you must be conscious of the rate changes that are happening and could potentially happen in the future when your mortgages come up for renewal. So it's key that you stay close to the numbers, you stay close to the news, and more importantly, stay close to your mortgage advisors and understand, should I refinance sooner rather than later? Should I break my deal? Is it cost effective, and beyond? And no, not one case fits all. As specialist brokers here at Our Mortgage Broker, we consult with our clients, we understand their goals and what they want from their portfolios. And it's even more imperative in today's market that people work with us more and more closely, so we can understand the numbers and the key drivers for them going forward. So that's my quick synopsis on the current market, and hopefully some tips on why I think buy-to-let is not dead. I'd encourage anybody that's viewing us live on all the socials to put in any questions in the social media comment channels. I'd like to hear from Bob as well. But again, this is Akil from Our Mortgage Broker. If anybody does have any questions, feel free to contact me directly. The website is ourmortgagebroker.co.uk. Thank you.
Thank you, Akil, for your synopsis. I'd like to bring Bob in to see what his view is about the death of the buy-to-let market.
Yeah, thanks, Akil. Very good resume of the current climate in the lending markets. Yeah, we've gone through a fairly turbulent 2 months or so. And I'll be honest, I didn't see all these rate rises coming, but I think if we didn't expect these rate rises to come, the Bank of England certainly should have done. You know, there was a war in the background, and they knew that, you know, the energy prices would be affected. So I think Bank of England was probably caught sleeping and napping when they ought to have been paying a bit more attention and being proactive rather than being reactive. I think that's half of the reason why we're in this mess, and half of the reason why inflation has been allowed to soar to double digits, and you know, it's expected to go even higher than the 10.1% that was the last time. So what's happened? Yep, the rates have gone sky high. You know, fixed rates are now sort of, you know, 6% on average. Discounted and tracker rates are sort of around the 3.5% level. So they're now gaining popularity because people don't want to pay 6.5%. They'd rather pay 3% and take their chances on any future rate rises. As Akhil said, yeah, the next meeting of the Bank of England is on the 3rd of November. I think the rate rise will be probably 1%. I know 0.75 is what's been bandied around, but I think if I was the Bank of England, I'd probably go and, you know, make a meaningful increase as the Feds did, you know, and make it, you know, sort of send a strong signal that the Bank of England is serious about tackling inflation, not just, you know, turning the screw lightly, but actually making make their presence felt by making a 1% increase to send the right message to the markets, because we know just how sensitive the markets are. You know, Kwasi Kwarteng and Liz Truss made the wrong moves in the mini budget, and look what's happened. You know, that sent gilts the wrong way, interest rates the wrong way, and we don't want that to happen again. So I'm glad Rishi and Jeremy Hunt have delayed the mini budget announcement to the 17th of November. That'll give them more time to crunch the numbers and see, you know, which way they want to go. It will also give the Office of Budget Responsibility a bit more time to consider the changes proposed. But it's all after the Bank of England rate rise. So the disadvantage is the Bank of England can't see what the budget has to say to take into account how big a rise they want to put in. So they might just be cautious and go all the way to 1%. So let's see what happens, okay? I suppose the topic of today is buy to let dead. I should be wearing a black tie, but I'm not. I took it off because I see there's hope. You know, if you'd asked me the same question last week, I would have said yes, definitely. You know, buy to let is difficult, particularly for new entrants into the market, because, as Akhil has just said, the figures in some cases don't work right now. It's no longer a given fact that, you know, you come up with 25% on the stamp duty costs, you know, and you can buy a buy to let. That's no longer the case because stress tests have gone from 5.25%, and all the way up to 7 and 8% in some lenders, although they're sort of, you know, coming back to normality slowly. You know, for that 2 weeks that have just gone past, it was difficult even to get any lender to lend without, you know, a significant deposit being tendered. And by significant, in some cases, I've seen 60% deposit required to actually make the numbers work. So the upshot of all this is that people are going to have to take advice. Yeah, they can no longer waltz into their bank and get a buy to let because it's not going to work. Yeah, they will need specialist advice for somebody, you know, from somebody like Akhil or myself, or indeed any other broker, and go through their, you know, numbers in detail, their goals and their aspirations and the cash flow requirements and the whole raison d'etre of why they're going into the buy-to-let market. Because people go into this market sometimes blindfolded, sometimes with misconceptions about what sort of, you know, fantastic yields they're going to achieve, without really realizing the long-term effects of going into this market. As we've seen, it's not always smooth sailing. Yes, we've had a fantastic 12 years where base rate's been pretty much negligible, but now I think we're returning back to normality. The average rate over the last 25, 30 years has been around the 5% level, and I think we'll be sort of coming back to those sort of rates. So whilst we're now being asked to pay 6% or 6.5%, that will drop inevitably as inflation comes under control. but I don't think we're going to see the 1s and 2s or 3s for a long, long time. Yeah, unless inflation really comes under control, back down to 1% or 2%, which is the Bank of England target now, 2%. Until it comes back to that, we're not really going to see affordable rates coming forward. I just can't see it. Now, the good news is long-term gilts, 30-year gilts are down. That's good news. But the 2 and 5 year and 10-year are still pretty high still. And that's not going to change until the inflation numbers indicate, positive news. So let's wait for that. So as Akhil said, anybody in a fixed rate already has probably little to worry about. Now, at Chess Mortgages, we tend to do 5-year products in the main. We never do 2-year products. So most of our clients are going to be quite safe for the next 2 or 3 years at least. By which time I think this maelstrom, this storm will be over. I think we'll be back to pretty much normality. But the big question mark is the next election. That's only 2 years away now. And, the Tories have really got a big task on their hands to get the economy under their control, get the numbers moving in the right direction, and hopefully win the next election. But it will be a difficult time for the Tories, as we all know. It's early days yet, so let's see how Rishi Sunak performs. But the market has reacted positively. FTSE went up, the dollar's up to, so the pound is up to 116. It's up against the euro as well. So far, so good, but it's just the honeymoon at the moment. The real test will come after the full statement on the 17th of November. So if you're a buy-to-let investor, yeah, fixed rates, great, hunky-dory. But the question is, when you come out of it, what's the landscape going to be looking like at the end of your fixed rate period? If that's next year, I'm sorry, but yeah, there will be a big payment shock. You're going to be leaving your cozy 2% or 2.5% buy-to-let rate, and that is easily likely to double. I think that's where we are going to be next year. Rates are going to go up. Base rate hopefully will be 3.25 if the Bank of England make that move on the 3rd of November. And the forecast is no longer will it reach 6%, but it will go up to sort of 5%-ish. Now, I don't think it'll actually hit 5%. I think that will do great damage to the economy. I think we'll probably finish at 4.5%, 4.75% at best before it starts to come down, because I think inflation will come down a little bit sooner than people think. I think prices are too high already. Wholesale prices of gas and electric are down, although that's not sort of come down into our bills yet. That will happen. I think the energy companies will be pressured into bringing down prices. So I think all these factors combined are good news for the property business, because UK is a property-led economy. Unless the property does well, the economy does not do well either. So we are looking forward to a fairly rough ride for the next 12 months, I think, 18 months. And then I think things will get better. As Akhil said, employment is high, so that's good news. Salaries haven't kept up with inflation, so we're obviously going to see a round of strikes now, where public pressure forces employers to pay them a bit more and try and close the gap between inflation of 10% and their normal pay rises of 1 or 2%. So there will be pressure from the employed or the employees on their employers to pay them more. And we've got the transport strikes, we've got the nurses looking at it, we've got other sectors looking at striking just to get more money. So we're going to see maybe a bleak winter of strikes ahead. So get ready for those. And the good news is property is still very much in demand, particularly new immigration coming in. People do want rental properties. There is a shortage, as we all know, and landlords are increasing rents, but how high can they go before tenants start screaming? So let's see. It's going to be an interesting 6 to 12 months ahead to see what transpires. But when people come out from their 2.5% fixes into the 5s and 6s, it's going to create shockwaves. So there are some quarters forecasting a price drop next year. I do feel that is likely. I think with rates that high, the first time buyer market pretty much dead. They can't really afford 6.5%. And the 95% products have also been sort of cut back greatly. So not only do they need a bigger deposit, first time buyers have to pass a higher stress test. And so I think all those factors combined bode badly for the market over the next 12 months until another scheme comes along for first time buyers. Help to Buy ends this month for new applications, although it's still valid until March for completions next year. Unless you've got your Help to Buy application in now, it's not really worth doing anything. So there are no other major schemes apart from the discount scheme, which, that's hard to get into. So I think all these factors, high rates, low wages, inflation, the uncertainty is the biggest killer. I think because of all those, I think we're going to have a pretty rough ride over the next 12 months. And only this morning, the Ernst & Young's Item Club said lending will be drastically down next year. So, if they've done their sums right, I think, we are looking at a slowdown in lending. So I'll be looking for a second job somewhere just to make up my shortfall somewhere. Maybe work for Akil part-time, I don't know. But let's see. But I think it's not dead, but I think it will definitely slow down. And I think people have now got to look at longer than the 5 or 10 year view they've taken before, because property cycles happen every 14 years, and they've got to be ready for the long game as well as the short game, and they need to make money throughout that time. So it could be that larger deposits become the norm to get good rates. That covers you, that covers the banks in terms of lowering their risk when they lend the money. So I think we might see new products come on board. We might see new lenders come onto the market with new ideas. But until the inflation situation eases or the interest rates come down, it's going to be a slow market. That's my take on the market right now. There we are. What do you think, Akil?
Thank you, Bob.
You raised some really good points there, Bob. I echo very much everything you've said. Yes, there is spooky times ahead. We can't hide away from high borrowing rates. They're there in the black and white. Everyone can see them and read them. But I think, as investors, and listen, I think we need to think with a property hat on. Everyone's gone in to become property investors with an entrepreneurial and business mindset. So I think we shouldn't forget why we've got into property as investors, because you and I are both investors as well as advisors, which is paramount as from a business leader perspective. So I think we should not forget about why we're in this business. And as we all know, business has its own ups and downs. It's how we pivot out of all life cycles and business cycles, which makes us stronger. I remember, if you all cast your minds back to Q1 of 2020, everyone thought house prices were going to crash because COVID's here. What happened to house prices? There were double-digit growths. There was people paying over the odds. There was a great incentive from the government that was put into place. So everyone was buying property. And what I would say is, the reason why I still think buy-to-let is certainly still not dead is because a lot of people are sitting on cash. So over the last 2 years, no one spent any money. No one traveled. People benefited from furlough, benefited from other schemes and not spending necessary for restaurants and holidays. So a lot of people are sitting on a load of cash and they're ready to buy property. And a lot of our clients, and our clients are predominantly in the buy-to-let space, raised a lot of liquid cash from their portfolios at those 1%, 2%, and 3% rates. And now they've got ample amount of cash to go and buy real estate property, either in cash or negotiate lower house prices, purchase prices, I should say. So it depends on where you're coming in from in this business. If you're a seasoned investor and your portfolio journey started in the 70s, 80s, and 90s, you're going to benefit, I still think, throughout this decade. But if you've only invested into property, and Bob, tell me if I'm wrong, if you've only invested in property over the last few years, potentially you're going to find it quite a drastic change because you're used to only paying 1% and 2% rates. Whereas Bob's going to say, by the way, your mortgage payment was £200 a month. Now that's shot up to £500 a month. And no one likes change on that particular side of it because the rent payments are still, where they are, but your mortgage payments have gone up. So something will have to give. Now, you might, as investors, listen, that's what we do as advisors. We try to help our clients. And what better way of doing it is finding solutions for our clients to mitigate those interest costs, and how do we pass on those costs to potentially our tenants? Now, it could be looking at rent reviews. Now, a lot of our investors don't do rent reviews with their tenants because they're happy with the tenants, they look after their property, and it's always washed its own face in terms of paid the agent fees, paid the mortgage cost, and it had a nice little surplus on the end for the landlord. Now, you might, as investors, want to look at doing rent reviews on your entire portfolio, especially if you haven't changed the rent over the last 2, 3, 5 years, because now's a good time to factor in rent reviews. And you might get a bit of pushback from the tenant to say, well, you know what, look, cost of living is going up, but you're charging me now an extra 20%. But then the pushback from a landlord's perspective is, well, listen, I haven't increased your rent for 5 years. So I've been a good landlord to you as well as you've been a good tenant to me. So I think there's a bit of negotiation to happen here, and we must think professionally. And obviously, you've got to look at health and well-being as well. Now, you know, COVID was a different health issue. We've now got a different health and well-being issue because of cost of living. You know, everything's going up, you know, petrol, food, drink, everything is going up. And, you know, we all have to eat and sleep and travel. So we can't hide away from that. But it's how we work collectively and find ways of finding solutions. So, yes, I still think, you know, as Bob said, we're in it for a rocky road ahead for the next, I would say, 18 months. But I still think there's lots of angles and opportunities for us to ride this wave out. Like we all thought was going to happen in COVID, totally the opposite happened. And I hate to say it, but I predicted this increase in interest rates back in 2020, off camera to a lot of people. But because of something called COVID turned up, it delayed the interest rate rises. And that's simply because of the amount of central bank quantitative easing that every bank in the world has pumped in. And naturally, that meant inflation was going to skyrocket. And to control inflation, the only way of doing it is through increasing interest rates. But that had to be delayed. And obviously, the amount of money that Rishi Sunak was then the Chancellor had to dish out, Rishi had to dish out there in 2020 for that obvious reason. So now it's time to pay back. You know, for people that sat on furloughs for maximum times, took up the 80% and took business loans, you know, now those people are going to have a bit of a shock. But what I would say is, you know, speak to the likes of Bob and I and other professionals in our industry so we can all work collectively and find solutions for us all.
Thanks, Akil. Can I put a question to both of you?
Sure.
You've talked about the recession coming and the rentals and everything else, and you said most of us took a view that the property investment was washing its face, so to speak, that there was not much surplus left in that. Now, with the interest rates rising, and that's going to hit every one of the property investors, if not now, in a year's time, or whenever the renewal comes up. With that in mind, how many do you think the new investors to the industry in the last 3-4 years are going to survive?
Well, I think it comes down. Oh, sorry, go on, Bob. Please go ahead.
No. I think most of them will survive because I think they met the fundamentals at the time in terms of the lender's requirements when they applied for those mortgages. So if they did buy a buy-to-let 3-4 years ago, the chances are it's risen in value by at least 20%. So that 75% hopefully should be 60-65% loan to value now.
Can I pick you up on that? It may have, that's a paper valuation and a paper increase, not a real one, which you cannot bring it into the market.
If we just take indexation, for example, you know, that's gone up by 20%, which is what the lenders work on. So even if you indexed, you know, across the board, you know, property prices have risen 10% year on year. So I think just taking those figures into account, those guys who bought 3 or 4 years ago should be comfortable. They're not going to be too disadvantaged. So they're not going to come out the market because as soon as you sell a property, capital gains tax comes in, selling agents charges come in, solicitors charges come in. So they're not going to want to pay that capital gains tax really. So I think anybody who's in the game will probably just grin and bear it for now, and hope that in sort of 2 years things get back to normal and they can take another product. And this is where advice from a good broker will come in, because we can see that is it a wise thing to do to lock somebody into a very high 5-year rate, knowing what we know, which is that rates will start to come down very shortly. So should we not be looking at shorter term products or variable or tracker rate products where some that you can exit without any penalty, for example, and then lock in when the time is right. So and there are many products on the market like that coming on stream purely for that reason, because the lenders know what's going to happen. So the good ones, the specialists, are launching new rates pretty much every day, and they are starting to come down slowly, but not fast enough, obviously. So I think product choice is very key for these guys who are coming off their rates next year. And there's 40 billion pounds worth of mortgages, 1.9 million mortgages due to expire next year. So a lot of them will be residential, and many will be buy-to-lets as well. And the good news is that some lenders now let you switch 6 months prior to the rate ending. So if you're on a good rate, you wouldn't really want to do anything now, and you'd see out your 6 month remaining period and then switch. But at least you can start looking now. You can maybe select a product from your lender based on today's rates, and not rates 6 months forward, which might be particularly high.
Yes, I accept that. But the thing is, those people who bought them got used to the income coming in and adjusted their standards of living accordingly. Now that street jump is going to affect them, but it's not what just happened 3 years ago. It's what is reality now.
Yeah.
So that is what is going to affect how it's going to affect the people. So what do you think that is going to be?
Yeah, I mean, obviously your cash flow will be restricted if your income isn't going up. You've not reviewed your tenancy agreement or your rent, and your mortgage payments have gone up. Then obviously that's going to leave you a bit squeezed. So most people, when they bought the buy-to-lets, didn't always take advice. They maybe should have bought in a company name, that might have bought in their personal name. So particularly high-rate taxpayers, they're going to feel it the worst. Because obviously the new, under Section 24, it's the gross income that's taxed, and they only get a 20% kickback on the interest. So the higher rate taxpayers are going to feel the brunt over the next 18 months, 2 years. They're not really going to see any income from their investment, and it's that category that will be the most vulnerable going forward. And when you haven't got the money to spend, you've not got that excess cash flow, whether that's buy-to-let or residential, that all gets fed into the economy, and that's what causes recession, because people don't then spend as much. They haven't got that capacity. So, my advice to anybody watching this is, start looking at your mortgage offers and see when they do actually expire. Start planning 7 to 8 months before that. Don't leave it till the last minute. And knowing what we know now, then, if you're for any brand new landlords going into the market, build in an automatic review on the tenancy agreement. Don't leave it to arbitration or negotiation when the time comes. Make it contractual from day one, saying your mortgage or your rent, will increase by 5% every year. And then you haven't got to go back and beg. So I think that's probably a good thing to do for new tenancies. I'm a landlord. I've also got a real estate business. I know how difficult it is to go to a tenant and say, look, can I have 50 quid more? Particularly when they're claiming benefits. There's no way you're going to get money out of them. They'll fight you tooth and nail before they start paying you any extra money. They'll find every reason under the sun not to pay you. Not just DSS type tenants, but even the private sector. They're going to find every reason, cost of living obviously being the biggest one, to not pay you that higher rental. So whilst in theory, yes, it's easier said than done, I would say. And Akil made a very valid point about auctions earlier, which I just wanted to touch on, because I see auctions as a barometer. I think if you do look at catalogues, you can get a pretty good feeling as to where the stock is coming from. Is it LPA receivers? Is it repossessions? Is it private sales? And most importantly, what percentage are sold in the room? Because if it doesn't sell in the room, that means it was either priced a bit too ambitiously, or the market just, won't wear that price tag for that particular property. So that's normally a very good place to look to see which way the market's going. And of late, the recent auctions have not been very successful. Whereas, there might have been an 80 or 90% sale. We're now looking at sort of 60, 65% sales succeeding. So that in itself should be a good indicator of things to come when people don't buy a property in the auction rooms.
Charanjit, you want to come in with something?
Sorry?
Yeah, thank you both. I think that's really interesting listening to you both. And I think, we're living in extremely uncertain and difficult times for investors and kind of the public alike, really, aren't we? It's like, in some ways, unprecedented. You've got the inflation, you've got increasing inflation, you've got increasing interest rates, you've got the war in Ukraine, you've got increased energy prices. It's kind of like it's all happening, isn't it? And like you said, Bob, definitely people are being squeezed. And that's where the affordability for first-time buyers especially, they will end up renting. Yeah. But when I look at sort of investors, and I know sort of Akhil, you're quite optimistic really. I suppose for investors, we've got to look at ourselves as business people, and what good business people do is look at, okay, the economy, the economics has changed. How do we pivot? How do we change our strategy? How do we look at other opportunities? And perhaps, yes, for a short term, like you said, Bob, there is a slowing down in growth, and perhaps prices will reduce, but does that mean that at some point in the line, there's going to be opportunities as well? And maybe not right now.
No, it's good. You know what it is? Going back to Swinder's question around, with the landlord's used to that surplus income. Now that the change of product means that the surplus income is not going to be 500, it might only be £100 now. You know what? The reality is the reality. Let's not dress it up. It means tightening our belts, not having that spare amount of cash to go to Cyprus or Palma or wherever we're traveling to next. It's tightening our belts. Unfortunately, we've had a good time as property investors with great yields, great surplus income, great opportunities to churn the property in terms of refinancing, capital raising, and going for onward purchases. That might slow down now. And I do believe that the purchase transaction side of the cycle will slow down. But what I don't think will slow down is people refinancing their properties to changing the product, because once your product comes up, you're either going to go on a standard variable rate, which is the bank's variable rate, as it says in the tin. But what you will want to do is tie into a deal which is fixed or discounted or tracked with the Bank of England rate to give you a bit more certainty. So, Bob and I, we know each other off camera as well. We're not going to hide behind and, dress things up where we can't, nor where we will. But what I would say is, it's time to tighten our belts. Look at the reality. We've had good opportunities to invest into property over the last 10, 12 years with interest rates so low. Those of us that have taken advantage of that, well done to you guys. Those of you that refinanced and leveraged your portfolios in the last 2 or 3 years and sitting on those 1-2% rates for the next 3 or 4 years, well done to you as well. But those 2 or 3 years are going to come up very, very soon. Time does fly. So what I always say is always look at reanalyzing your portfolios, how you can find ways of leveraging your outgoing costs. And as Charanjit said, we've got lots of pressures, local to home and abroad. But what we're going to do is, we can't sit on our hands. We've got to make sure that we're talking to the right people and doing the right thing. Now, Lloyd's mentioned, I think it was today or yesterday, that they expect house prices to come down 8%. In 2020, a lot of economists thought house prices were going to tank 10-20%. Now, everyone can think, up, down, left, right, yeah. But what the reality is, everyone is an individual. Everyone's circumstances are different. Everyone's income and expenditure is different. So you should do what you think is best for your own pocket. And by doing so, speaking to the right people, not your friend Dave at the pub or somebody that's not invested into real estate property, because then it's pointless. Because if you read real media news, they're going to put a downer and a dampener on every opportunity. So I would always say surround yourself with the right people. And as what I forgot the quote from Warren Buffett, but he always talks about, you know, where there's a recession, you know, people get either frightened or take opportunity and they take that opportunity or beyond that. So I would say is, you know, there's an opportunity in every down cycle and up cycle. It just depends how brave you are in this cycle.
Thank you.
Yeah,
Sorry.
thank you. Thanks, Akhil. I was just going to ask you, what about, do you think there's a danger for those people who maybe got over leveraged portfolios?
So there's no such thing as actually over leveraged portfolios. And the simple reason is the bank will only lend a certain percentage against the value of a property. So typically for a buy to let, the lender will lend up to 85% of the value of that property. Now, if house prices come down 20% tomorrow, then the bank is actually underwater and so is the owner by 5% in that calculation. But realistically, that's why the banks offer you a loan to value, because they are certain, or in their own views by their own economists within their banking division, to say, we've got enough buffer here to cover any storms coming up. So if you look at the average landlord in the market, they're not ultimately geared up to 75 or even 80%. Typically, they're geared up to about 60% across their portfolio. So they've got plenty of skin in the game there to weather any storm ahead. But as we all know, you know, house prices can come down, and we saw that in 2009. But that was a totally different recession, a totally different crash, where that was a liquidity issue. Between 2009, 2013, we saw a house price crash. But the best time to buy real estate over the last decade was 2013 and beyond. So there is cycles in the market, and they say every 14 years we go through a property cycle. They say every 10 or 12 years house prices double. That might now be extended out by 2 or 4 years. But if you look at the house price trends in terms of house values, they've always been going in one direction, which is positively. Now, if we see a price, I say not a crash, a price correction, because over the last 2 years, we've seen double-digit growth. Even if it does come down 8% as per Lloyd's forecast, those investors that bought in 2015 are still up on their capital appreciation because they bought at that time. However, somebody wanting to buy a property now is probably priced out of the market because of the stress tests, because the affordability and the interest rates, therefore their repayment. So they've got to take a view on everything. And you know, I'm a big believer of, you know, today is still the cheapest day to buy property, because house prices, if you look at the trends, always go in one direction. It always goes upwards. So my motto is this, you know, if you can afford, if you have a deposit, you have good income, and you can cover the repayment costs for the foreseeable future, then it's a good time to buy in real estate property. Otherwise, you're going to rent and you're going to pay somebody else's mortgage. I understand the flexibility of people why they rent. They can move from town to town, or they might want to get married and move abroad, and I understand it. Not everybody should own their own home for their own reasons. But I'm a bit old school, where I like to own where I live. I actually like to reduce my mortgage as soon as possible so I can live debt free. So heaven forbid anything to go wrong, at least I have a roof over my head, and I'm happy to eat beans on toast, which I actually genuinely enjoy.
That's good. Okay, a question to both of you. You, Caleb, said the Bank of England might raise interest by 3.4%, and Bob had said 1%. Now, taking that into consideration, what do you think the buy-to-let interest rates will go up by?
Bob?
Yeah. I mean, if the Bank of England does put base rate up to 3 or 3.25, the tracker rates will move in line with that product. So where the bank is linking their rates to the Bank of England rate, then that will move up pretty much next month or the following month. Where it's a building society, for example, and the rates are linked to the SVR rate, and the lender offers a discount for a given period, then that too will go up in line as and when the lender moves their SVR. Now that may happen, that may not happen. It very much depends on the society's view if they want to, you know, put more pressure on their members. So building societies are normally a bit more reasonable. They tend to have a delayed reaction. They don't actually put the SVR up on the same day as the Bank of England rate goes up. So, sometimes being with a building society is better, but when rates come down, they're also a bit slow to move their rates down as well, whereas a tracker is a bit more, open and a bit more transparent. But yeah, I think rates obviously will have to go up if Bank of England puts their rates up. And yes, as Akhil said, that will, put a squeeze on your net income, which has the long-term effect of lower revenues for HMRC because, higher deduction from your expenses means less net profit.
Provided you're a limited company.
Yeah, obviously, unless it's a limited company, of course, yeah. But then even so, your net profit on a company account is also post-tax, isn't it? So if you're paying too much interest on your mortgages, the net profit's going to be less either way. So that will be less HMRC revenue in the following year.
Yes, I appreciate that, but the people holding property in their personal name will not affect them because they cannot claim
No,
any
not in personal names yet. No, I'm talking about buy-to-lets, obviously, just at the moment.
Mm.
But the effect of higher mortgage payments is less money to spend, and that's what is going to cause the recession. So we're expecting that. That's pretty much on the cards. With falling house prices, Akhil said, Lloyds are saying 8 to 10%, whatever. And it's not just Lloyds, it's many people. But it's just that we've got still a huge appetite for home ownership in this country. Employment is still good. So as long as those two factors are there, it won't be a major crash. It'll be a correction. But yeah, as I say, just batten the hatches, budget, cut out any unnecessary expenditure from your personal life or even, the business side of things, and just have enough spare cash in the bank to ride out any negative cash flows or voids, because as the economy gets worse and as people maybe start to lose their jobs, that will translate into voids for landlords as well. So, if the tenant can't pay, you're going to have to pay. And if you've got 10 buy-to-lets and, 3 of your tenants aren't paying, that's going to place enormous pressure on you. And for that reason, lenders are really, really tightening the screws on portfolio landlords, knowing that this could happen. So they're now setting the bar higher for portfolio landlords because they want the portfolio to be, pretty robust going forward.
Yep. Yes. Okay. Fine. Thank you. Now, Akhil, do you have anything to add to that?
Yeah, no. So echo everything that Bob said there. The only thing I would add is when there's a rate increase by the Bank of England, there's two sides. You've got the regular banks that you and I all know on the high street and the building societies. They would usually follow that Bank of England rate very closely, and they'll increase their rate by 1% if it is 1% increase. However, the other lenders in the market, i.e. the specialist lenders, are funded in different ways. Banks and building societies are funded by their depositors, so they've got to pay them back in the interest in their savings accounts. However, the specialist lenders are funded differently. So they're usually funded by larger institutions, hedge funds, and usually by US companies. Now, what that means is their funding costs them more than the likes of Barclays, how they're funded. Now, if you've got a mortgage with the likes of, I won't mention any names, but anything specialist out there in the market, they're usually funded in US dollars. At the moment, US dollars is very, very powerful currency, and it's going up against the pound. Pound is weakening compared to the US dollar. So what that means is the specialist lenders who are funded in typically US dollars, they will have to increase their rates a lot more higher than the UK banks that are on the high street that you and I will know of, because they're funded in that way. And the investor market for the specialist request a higher rate of return on their deposits that they lend out on. So just being conscious of the difference and the divide in the mortgage lenders in that market is, if you've got a specialist lender, just be conscious that if it's a 1% interest rise with the Bank of England, the increase that they're going to increase by is going to be a lot more than a high street lender will do. So you're just going to be conscious of the different lenders and how they're funded, because ultimately they're going to pass on that cost to you and I, the borrower.
That's a very good point. That's a very good point, Akhil. Choice of lender in any product is quite important, because the specialist lenders are different animals altogether. You know, they don't have a branch network or anything. They don't have a public image to maintain most of the time. And because of the way they're funded, they can be quite ruthless. They can, withdraw offers and that sort of thing. So, that's happened during the last month or so when people have had offers and had them pulled as well. But the most important thing about entering into an agreement with a specialist lender is that in the years to come, you may not be with that lender because these lenders tend to sell their books just as the high street. So you could actually be palmed off to somebody else. And, whereas you might be thinking, yeah, I'll get a nice product transfer in 5 years, that's not always guaranteed. If you're shipped off to one of these back book managers, they're not going to offer you any products if your debt is sold on to them. So just be a bit careful when we deal with specialist banks, purely for that reason.
Thank you. Charanjit, do you have anything else you want to come in with? You're muted.
Right. So just to remind me, what did we say in terms of interest rates? What's the highest you think that they're going to reach?
I'm going to stick my neck out and say 4.5.
4.5.
Yeah, I'm going to stick my head out. So I think by Christmas this year we'll be at 3%, and Christmas 23 I think we'll be at 4.25. But I agree, like with Bob, I think we'll cap out or tap out about 4.5% before inflation sees under control, and then we'll see that dwindling down. But I don't think it'll come down as quick as they've gone up, unfortunately. So hence why I still think, if Bank of England's at 4, that means fixed rates are probably going to be 6-ish. If Bank of England's at 3, they're going to be at 5-ish with fixed rate mortgages. So, the era of 1% and 2%, as Bob said earlier, those days have probably gone, unfortunately. We wish them back very, very soon. However, when I first bought my property in 2005, I think I paid 5.25%, which I thought was great. And I remember, I was singing off the praise. I was like, fantastic. But we've offered mortgages to our clients at 0.99, 1.5, and we're like, wow. But listen, we've enjoyed it. Those that are being benefit from those rates, well done. It's all about timing and a bit of luck. But again, you make your own luck in anything you do in life.
Great.
Okay.
Thank you very much.
All right. The other point I'd like to raise is we keep saying that there's a recession coming. If the recession, as everybody agrees, is on its way, it's going to mean contraction of the economy, which means less growth, incomes will affect, unemployment will go up. We keep talking about full-time employment, full employment and very high employment rates, but they are artificially massaged. Not everybody in that is full employed and can afford to live on that salary. With the recession coming, and all these people, more people going either unemployed or whatever, where are we going to go there?
Well, listen, I totally agree with everything you've said, and I don't think we're entering a recession. I think we're already in a recession, and I've said that live on video many, many months ago. I think we're already in a recession. I know the rule of thumb is 2 quarters in a row before you enter a recession. As much as I'm an optimist, I'm a realist as well. So I don't want to put the frighteners on anybody, but it's there in black and white. Everyone's costs are going up. So I certainly believe we're already in a recession. I believe that we're going to have a long period of stagflation, which means the economy is not going to grow as much as it needs to, and inflation will continue to rise, which means stagflation. No country can afford to be in stagflation for longer than a day, let alone a year or a 2-year cycle. So it's how the government works with the central banks, i.e. our central bank, Bank of England, in how to pivot and come out of this. But, running a country and running the books of the country of our size, it's not an easy day out. We've got to bear in mind there's different landscapes and different horizons that everyone needs to work with. It's not just, everyone's in real estate, people are in different sectors. You've got to look at defense, you've got to look at the NHS, you've got to look at social. There's lots and lots of demographics that they need to weigh up. Now, there's talks of filling this this deficit in this budget of 40 billion. You know, how are they going to do that? You know, the simplest answer is increasing taxes. And usually what happens is the private rental sector, i.e. us landlords, are hit first because we're the easier targets. But that's not going to fill the entire black hole of that deficit of that budget. They've got to find other ways of cutting costs. You know, I would not want to be the chancellor. I wouldn't want to be the PM, let alone the chancellor of any country. So I wish Jeremy Hunt and Rishi Sunak all the best with that. But again, you know, it's not an easy job. But this is done. This is, you know, this stagflation and this recession that we're into is done on our own accord. And I believe, you know, furlough was too generous. The amount of quantitative easing was for too long. And nobody thought of how are we going to repay this debt? It's very easy to take the credit card out and spend it in Selfridges. You know, how are we going to make those payments on a monthly basis going forward? So nobody really thought that out. But, you know, if we look closer to home, as I said earlier, you know, we need to start thinking about tightening our belts. And as Bob said, you know, cut back on unnecessary costs and seeing how we can shave off unnecessary costs. Bob?
Yes, yeah, we are in a recession, there's no doubt. And when inflation is 10%, you can't be a good economy. I know we're not used to high inflation figures in this country. You know, the Bank of England target is 2 and we're 10.1 and rising. So I think, you know, we are going to go into a recession. Yeah, we're going to hit the technical definition next month when we get to 2 quarters negative GDP. But yeah, as I've said, it's going to be a tough ride ahead. I think we all have to batten the hatches a bit, you know, take care of our finances. I mean, the UK is a time bomb when it comes to personal credit card lending. You know, everyone's, you know, got lots of personal debt, let alone mortgage debt. So what's happened is for the last 10 years, it's been a real honeymoon period where, you know, mortgage rates have been low. We've taken on additional debt over and above what the mortgage was. So we might have taken a secured loan, we might have taken a car loan, you know, so all those debts still have to be paid. Now that mortgage rates are going to go higher and your mortgage payments are going to go higher, you've still got those debts in the background. So most people never ever tend to clear their credit cards. You know, it's very difficult to, once you're in that cycle, to actually eat into that credit card debt because of the APR so high. So if you're still, you know, if you've still got a good credit history, look at debt consolidation. You know, get rid of those debts and come on to a standard mortgage with the caveat that yes, you could pay more over the longer term, but it'll bring your payments down. I think it's now the time to actually get prepared for what's about to come. If you do have lots of personal debt, speak to a broker, see what you can consolidate, what you can't, and see whether that puts you in a better position on a monthly basis, because you're going to need that. As soon as you come out of your fixed rate, payments are going to go sky high. The car loan is not going to stop. The credit card payments still want their money. And the moment you miss a payment, guess what? Your credit file gets marked, and that makes it difficult then to get a mortgage, maybe another product at the end of your period. You then enter that spiral to the bottom. And the worst thing that can happen to you in this climate is your credit history to be affected. You must register with one of the agencies, make sure you keep tabs on it, make sure there are no errors on there, and whatever you do not miss any payments. Make sure you've got income protection in case you lose your job or become sick. Make sure you've got life insurance in place. If worst happens and one partner dies, at least the mortgage can be taken care of, because without all these safeguards in the back, the house of cards will tumble. And, you know, this is what my advice is to all our clients. Look at all your financial planning, speak to a broker that can guide you in all of these areas, and is not just quoting you, you know, rates. It's got to be an overall advisory service that you want. The new consumer duty rules highlight this, that every aspect of the client's circumstances need to be considered.
Now that we've brought the government into it, what do you think will be the effect on landlords of the Section 21? Go ahead.
I think, as Akil said, we're an easy target. They know that they can get us because we're on the radar. And as more and more become corporate landlords, you know, you have to file your company account. So I think they're going to not relent on the Section 24 changes. I think they'll...
Oh, no, sorry. It's section 21, the eviction.
Oh, the eviction, sorry. Beg your pardon. Okay. I would like to see landlords given more power to evict, particularly where there's a habitual late payment record or abuse of the system. I get it that there are certain circumstances where the tenant can't pay through genuine reasons, and you have to go through the courts to actually evict them. But I think the no faults ban was wrong. I think landlords do need that flexibility to get their property back if they need it, and the tenants will have to find somewhere else. And that's the way it goes. I don't think we should be forced to hold on to a tenant just because they are tenants. It's our property at the end of the day. The government is being helped by private landlords because we're providing them with the stock to house these people who maybe claim benefits, etc. We're doing their job for them, and we're the ones being punished by the government. So I think that's quite incorrect. I think we need to be taken more care of and encouraged to buy more property so that we can actually offer tenants that accommodation, which the government can't do because they're not building the houses that we need in the economy. They're a million miles from the 300,000 annual target. Whereas, if you encourage and entice landlords to buy more buy-to-lets, a lot of the tenants' needs could be fulfilled. And look at the asylum cost, £2 million a day.
Yeah, well, that's another topic. I think
That's another topic. Yeah. I mean,
Akhil, you got anything to add to that?
The way I look at it, I think the tenant's always going to be favoured, just simply because of humanity reasons. It's like the cyclists on the road; they're always going to get the benefit of doubt, right? So I think we've just got to live with that. But I think what we can do is just get smarter on how we induct our new tenants in. So I think it's up to us. Remember, listen, it's our property. We decide who lives in our property. So we shouldn't just leave it to the agent, albeit that I'm sure they're doing the right job and finding the right tenant. But for us to get closer to the tenant, understand where they live, where they work, their income, how long they want to stay for, what's their track record. So we need to become agents within ourselves as landlords. Do your own referencing. How clean is the references? Look at, I'm a bit old school and I like to see the whites in people's eyes. Every tenant that's come on board into our properties, I've actually visited them on site before they sign the contract, just so I can make a decision myself. So I'm a bit old school and I like to meet my tenants before they sign on the dotted line like I do. And touch wood, so far things are being very good from that perspective, and long may that continue. The only thing I would say is we've had lots of housing ministers. That's an ever-changing world at the moment. I think we've got Michael Gove coming back in at the moment as well. So I think he's pro-property. Let's see what he brings in. But what I would say is, there's only so much that we can control. At government level, unfortunately, I haven't got the power to control anything. I'm not sure you have Bob or Surinder has. But what I think we need to do is, try to take control of what we can take control of. If we don't want to have any Section 21 problems tomorrow, induct your right tenant on day one. It's up to us who we agree to move in. So it's up to us. We can either build fortunes or we can, create problems for us in the future. So, it starts with us. The buck does lie with us, and it's how we then move forward.
Okay, thank you. Unfortunately, we're coming to an end. And before we end, the final question, I'd like to put you both to the test and predict what you think the property market will be at the end of 2023. What sort of drop you envisage?
Okay,
or a correction, as you called it.
Yeah, correction. Yeah, I think there'll be regional variance. I think maybe London will drop more because it's already very high, and the regional variation will be less. So I think the range will be sort of 10 to 15% depending on region. I'd like to think it's going to be less, but I do feel the sudden surge in interest rates is going to send a payment shock to many people, and that will unnerve many and deter many of entering into the market, and that will have a knock-on effect of actually stifling demand, and therefore prices will have to drop to rejuvenate that demand going forward. So 10 to 15%.
Okay. So I did a video with another firm a few weeks ago, and that question came up as well. And I was quite frank, and I said, like Bob said, I think it's going to be regional. I don't think we're going to have a price reduction whatsoever. I still think we're going to be hovering around 10% year-on-year price increase. Like some parts of the country are still underwater from the 2009 crash. So I'm still a big believer of house prices will remain, particularly London and the southeast centric, about 10% in house price growth. I still think the growth in some rural parts of England won't see great growths. However, they still will remain positive from that perspective. So I'm still very optimistic, very close to 10%, but it's going to be regional. But London and the home counties and the southeast of England will see circa 10% growth.
Yeah.
Okay, sorry.
I
carry on.
think the race for space is ending. I think a recent report said people are heading back towards the cities. So I think cities might be a little bit stronger or less affected because people now want to get back into the cities and start coming to the offices, even though it might be a hybrid model still, but people are coming back into the cities. A recent report highlighted. And just to pick up on a previous point, I think every landlord should have insurance in place for loss of rent where the tenant doesn't pay, to include court fees, because many landlords skimp on that very little cost policy, which if they had that in place, then it would negate a lot of the problems that landlords face when tenants don't pay. So I think having that insurance is absolutely mandatory.
Thank you, Bob, and thank you. Just to finally summarize, Bob, in your opinion, there will be a correction downwards from
I
between
think there
10,
will be a correction. Yeah,
10 to 15%. And
Yeah.
Akhil, you think it will be mainly a correction up to 10% upwards? Is that,
Yeah, I still think house prices will remain as is. Yeah, as is.
okay.
We've seen 10% increase. I think it will remain the same in
Okay,
most
fine.
parts.
Thank you very much. It's been a very interesting afternoon. And thank you both very much for your contribution. It's much appreciated. Thank you again.
Pleasure.
Bye.
Thanks for having us.
Thank you.
Thank you, everyone. Take care. Good night.
Bye.